Well, this week we're reviewing the Allan Gray Stable Fund. The fund is managed by Ian Little. The formation date, July 2000. Fund size there, massive 29 billion rand. That benchmark, an interesting benchmark, call deposit rate with FNB plus 2% after tax with a 25% tax assumption. The TR low at 1.52%. Cobie, firstly, just explain this benchmark that they've used, why they've got this after-tax assumption there.
Yeah, I mean, it's an interesting development because, quite frankly, you don't quite often see a benchmark to this degree. I think that one of the big reasons is because a lot of investors that are invested in this kind of fund are retired. You can see by the fund size, it's been around for quite a bit. It's very, very popular. And hence they're trying to achieve a return in real terms, but after tax. And hence they're taking a total assumption into consideration here. So they're trying to beat something once they've subtracted tax out of it and everything else, so they can try and give somebody kind of a grossed up return, but kind of, taking tax into consideration.
Which makes a lot of sense. I mean, surely you should see more funds doing this.
Yeah, and as a matter of fact, I mean, the better asset managers and people that kind of focus on the retirement space, do take that into consideration from a modeling perspective. The question, though, becomes what kind of tax rate do you use? Do you use 25%? Do you use 30%? The interesting thing for me here, though, is that they're using FNB call rate plus 2% beyond that. Why not just CPI plus 2? Why not just, there's
interesting. I mean, why they've
a whole bunch of deviations that you could use. Yeah, why the FNB rates, specifically? But I mean, this has been going for quite a while, this fund, and it has been very, very successful. As a matter of fact, if we could show you some returns for this fund, just have a look on your screen there at the moment, and you'll see the Allan Gray Stable Fund. You'll see the 1-year, 3-year, and 5-year returns for the stable fund relative to its benchmark, and that benchmark again is FNB call rate plus 2%, and that's after a 25% tax rate has been taken into consideration. Just to give you an indication quickly of what this fund looks like, and just from a return perspective again, and what I've done over here is I didn't use a specific benchmark, but I've used CPI plus 2% just as a rolling benchmark, and there you can see it in the red line over time. And it shows you how the fund has underperformed or outperformed relative to that CPI plus 2. If you just look at the blue shaded areas on the graph at the moment. A nice conservative fund, well suited to those individuals that want to retire, and often quite a favorite.
Yeah. As at end of June 2012, just looking at asset classes, money market and bank deposits 44.8%, net equity 16.9%. They also indicate that they're hedging some of that equity exposure, a small, very small portion, under 1% of property. Commodities in gold 2.7% and bonds 8.4%. So clearly it's around cash conservation, capital preservation.
Yeah, it is positioned for conservative times as well as for conservative investors. The two things that stick out for me is using a cash rate as a benchmark, cash plus 2 in this case, and having such a high proportion in equity raises the question of, is this a relevant benchmark to really compare it to? I personally don't think so. If you correlate the fund's returns to cash plus 2, you'll get a very low correlation. So if the benchmark is lowly correlated to what the fund is doing, why are you using it, right?
Well, what other benchmark would be appropriate?
Well,
we had to kind of
generally, the benchmarks, the most accurate benchmark is to say what are the risks that the fund are taking, in other words, asset class exposure. And once you know what those are, you can then see what the returns are relative to those risks, because the definition of skill is what you generate over and above the risks that you are taking. So I don't think this benchmark fairly reflects the skill of the manager necessarily. And also you've got a big portion here in hedged equity. Now, we don't really know what that is. Generally, you are paying a performance-based fee here for probably a derivative kind of structure underlying it. Now, you could buy that kind of derivative directly yourself through an investment bank. You don't have to pay an asset manager performance-based fee necessarily for that. So these are sort of issues with the fund that I have. But other than that, it's got some commodities, which you also don't see often, which is a good thing because it gives you that extra diversification. Again, gold is a proxy for panic and bad times. So
is it? Question mark these days, but anyway.
Well, I mean, it's quite interesting to see how gold has actually come down in value, just over the last 12 months relative to all the other resources, So I think people are starting to say, I mean, it's run its course. I mean, how much
certainly
longer
run
can
its course from the $280 levels.
No, absolutely. I mean, if you look at this fund, I mean, I don't know, Roland will attest to this. I mean, a decade ago, it was pretty difficult to find funds that are in the absolute space. Often when we spoke about funds in the absolute space, there were very, very few of them, and they were true, in the true sense of the word, kind of absolute funds. Today, absolute funds have kind of become flavor of the month. Everybody's got an absolute benchmark. As a matter of fact, even if you don't have an absolute benchmark, if you've got a market-related benchmark, you have at least a derivative thereof that is absolute related. And the reason for this is because people are trying to target returns. People are trying to retire on these kind of on capital. And then the question now kind of remains, you're kind of saying to people, look, we won't lose your money, and at least you'll be able to stay, in real terms relative to inflation. But then again, how appropriate is that relative to, to the total fund? So I mean, I fully agree with what Roland was saying just now. As a matter of fact, let's just quickly show you what the asset allocation looks like for this fund. And there you can see it. It's literally a money market fund. You can see 44.7% of the capital in money market, and you can see the rest of the capital, kind of spread amongst kind of equities and so forth. Again, the one thing that I think you must kind of take into consideration, if you're going to be retired, over what time periods are you going to be invested here? If you want to be invested over 12 months, this is not a bad option. If you want to be invested over a decade, why are you invested here?
Certainly. I mean, just looking at the returns, if you were showing us those returns, they're just merely beating inflation, just merely making, there certainly isn't a fund for you that if you're looking at a 10-year, even 5-year perspective. What do you think?
Yeah. If you want to beat inflation over 5 years, you have to have inflation correlated assets. In other words, that give you that kind of protection, which this fund probably does have. But
certainly, aren't you taking that into account if you are using that deposit rate? Kind of through
inflation and the deposit rate should be highly correlated, right? Yeah. As inflation goes up, interest rates sort of adjust to that. So the question is, why not just use CPI plus 2 and call a spade a spade?
As you say,
that's the real question. I think what one also has to take into account is if you're going to invest in this fund over a 5-year period, at some point we are going to come out of this economic malaise globally, and it's probably going to happen in the earlier part of those 5 years. So putting your money, if you are a long-term investor, into a conservative fund now might not be necessarily the right thing. I'm sort of expecting more of a growth environment in the next 5 years than another 5 years of defensive kind of exposure.
So this fund is for someone who is going to retire within the next year or is already retired?
Well, not necessarily again, because again, it depends on what it is you're trying to achieve. What is the total objective that you're trying to aim for at the end of the day? Retired individuals often sit down and say, you know what, I've got this pot of money, and if I lose this pot of money, then I'm in serious trouble. Then I don't have anything else. And quite frankly, I can't go back and work. So I'm going to try and be as conservative as I possibly can be. And hence, these type of funds then kind of come into the foreground and fall in the spotlight, and people say, how do I interact with these funds? But often the better thing to do is to kind of invest for growth. Because quite frankly, if you're going to be retired today, you could be retired for 30 years. And 30 years is a very, very long time to be retired. People that make use of these kind of funds invariably have so much money that they don't mind having a low growth environment. And invariably, those kind of folk in any case invest in equity. So they don't make use of these kind of funds.
Yeah.
But again, it depends what it is you're trying to achieve and how it is that you're trying to achieve it. You might want to achieve this with a portion of your capital. You might not want to achieve this with 100% of your capital.